Jim McCaughan, CEO of Principal Global Investors. Nice to see you at the Global Conference
Great
once
to
again.
see you, Rhonda.
It's always a pleasure to hear you speak on some of these panels, and you had some very interesting comments on a panel about the economy. We look at the numbers, economic growth in the first quarter, almost scary. It's supposed to be better now, not great. But you think that some of these numbers we look at really are a bit outdated.
Yeah. The one I'm really skeptical of is real GDP. You know, the Federal Reserve last week were looking at 0.5% growth in real GDP in the first quarter, but a labour market behaving as if it's growing at 2.5%. There's a paradox here, and it can't be that American business has suddenly got slack and is employing people in an inefficient way. I don't believe that one. So I think about what has actually driven real GDP, and my thinking is that we've got a bit messed up on the inflation measures, and that really what is happening here is that products and services are getting cheaper, and they're getting cheaper and better performing. I'll give you an example. The car you buy now is not the car you bought 10 years ago. It's got all kinds of collision avoidance technology built into it. It means it doesn't bump into things so often. It means fewer repairs. The cost of ownership is quite a bit less than it used to be for all those reasons. You could spread this across any number of parts of the economy. I believe that the volume adjustments in real GDP are basically wrong, and that the economy, if you adjusted for quality of goods and services, may be growing a bit faster than we think.
So should the Federal Reserve be more aggressive than it is then?
Well, I think the Federal Reserve should be focused on the labour market, which I suspect in the end they will be. You know, there's another thing going on with this deflation, which is the equilibrium rate of short-term interest is going to be very close to zero, maybe even occasionally negative. That's what deflation does. And as a result, there's really no need to move much when you have a 10-year yield at a little under 2%. I would have thought 1, maybe 2 rate increases in the next year. But you know, the peak this cycle could be a 1.5% Fed funds rate. I think the Fed has done really quite well with all the confusing signals.
So how do you look at those signals as somebody who is investing a lot of money for your clients? Does that mean that you look, for instance, at the technology sector differently or heavily into equities than fixed income?
Yeah, I think what's going on here is that there is a lot of uncertainty and adjustment going on. Relative prices in assets are still adjusting to a reality that's not totally clear to people. But I'd give you a couple of examples. One is there are still some very inefficiently priced sources of good yield in the market. Real estate. US commercial real estate still yields over 5% on average. That's terrific in this sort of economic environment. Even high yield bonds. The yields have come in a lot. They've done quite well in the last month or so. But I think they're still overestimating the likely defaults. So look for inefficient pricing. The other thing I would say, if it's a long-term, low-yield, low-rate environment, I don't know if it is, but it seems a fair working assumption, then business models that work will really prosper. This should be, looking forward, a good stock selection market, particularly in small and mid-caps and some of the emerging markets around the world.
What would be one of your more favorite emerging markets right now? Any country in particular that's exciting you?
On emerging markets, not really. I mean, they've done very well in the first quarter. I think that may be a little premature given the fundamentals. But I do think the way I look at emerging markets is, if you're prepared to own them for the next 5 years, you'll do rather well. If you need the money next year, maybe not so much.
Jim McCaughan, always great to see you here at the Milken Conference.